So, selling options. Why is it appealing? I have a little hint over my left hand shoulder. We're going to talk about it today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic, where we discuss the markets and options. And today we're going to talk a little bit about option strategy. Last week, I talked about synthetics. Synthetics are the idea that you can use different securities and essentially synthetically replicate other securities. On Monday, one of the things we talked about is the idea of replication and using that replication to model what derivative securities might do. So at a simple level, for anybody who didn't watch that, the whole idea is that you can replicate the behavior of an option by trading the underlying asset on which that option is based. And what that means is that if you don't have a call option, you could actually create one yourself. So a call option is going to give you participation that looks almost completely like the underlying asset when it is deep in the money. And it is going to give you behavior that is almost nothing like the underlying asset when it is far out of the money. And so by dynamically adjusting how much of an underlying asset you hold, you can in theory replicate the value of an option. This is the principle upon which market makers actually price options, because they can sell a call option and then synthetically replicate that option by trading the underlying stock, by delta hedging it. And if they can identify some edge between what they believe it should be worth, what they anticipate that replication strategy's payoff will be, and the price of the option, they'll capitalize on that by buying it when it is too cheap and selling it when it's too expensive. Now, the interesting thing about this is that it creates a strange dynamic. And that strange dynamic is as follows, which is that if a stock is very volatile from 1 minute to the next, from 1 hour to the next, and from 1 day to the next, then you can realize a lot of that by trading the stock back and forth. But if the volatility that the underlying stock exhibits from 1 week to the next or 1 month to the next doesn't scale the way you expect it to, then what's interesting is that you can end up with this very strange situation where a person can buy an option and hedge it dynamically and make more than they paid, and the seller of an option can just sell it and not hedge it, and they can actually have a positive expected value as well. And this is one of those interesting dynamics that exists in options that a lot of people probably don't recognize, because the general idea is, the general expectation is that in trading and in investing and in business, it's a zero-sum game. That your gain is somebody else's loss, and somebody else's gain is your loss. But that is not actually always true. And that is because in the example I just provided, the counterparties aren't doing exactly the same thing. So if they were doing exactly the same thing, then less trading slippage, fees, and expenses, indeed it would be zero sum. In fact, if you think about that as being unnecessary friction, unnecessary transaction costs, then it would be less than zero sum. But that's not actually how it works out. So let's look at an example, and this is the example I was talking about because I just happened to be taking a look at this. So I know quite a lot about the Worth ETF. The Worth ETF, which just launched recently, it is on the Title Financial Group platform, and it was started by Carter Braxton Worth. And the reason I like to use this as an example is because I often like to use the funds that we have, the YieldMax funds, to talk about selling options. But the reason I'm going to use this one as an example in this case is because the Worth ETF does not also make a directional bet. And sometimes that can cloud the issue, right? So if you buy a stock and you sell a call against it. You're synthetically selling puts. You're taking a long delta position. Let's go through some examples and we'll kind of take a look at what this looks like. Actually, you know what? I talked about this on a video that I did on the CNBC website that was published earlier today. So I encourage you to check that out. If you Google SpaceX, SPCX, and my last name, Co, and CNBC options action, you'll probably find the video. But I'm not going to ask you to dig too far to go find it, because if you don't find it, I can share with you essentially what I discussed. And this is basically it. So I started here. And one of the things I was talking about, so for you, those who don't know, SpaceX options started trading. I mean, how could you have missed this? Of course you know. If you've been living under a rock for the last 48 hours and do not know, SpaceX options began trading yesterday. And SpaceX itself, the IPO set a record. When the options started trading yesterday, they too set a record. So it was the biggest IPO in history. It's one of the most valuable companies in the world. It minted the world's first trillionaire. And yesterday, when SpaceX options started trading, it traded almost 1.8 million contracts. That was third in single stock options contract volume overall, trailing only Tesla, which was in number one place, and NVIDIA in second. And that actually, the total contract volume in SpaceX exceeded the two single stocks in fourth and fifth, which were Apple and Netflix, respectively. So I just backed up by one day, or I'm supposed to have, but it's not populating. So let's see what happened here. I'm going to do that one more time. SpaceX, -1. What's supposed to happen is it's supposed to pop up and populate. Oh, that's why. It's not live. So let me see what's happening. Is this it? Okay, I think I have two windows going at once, and that's probably creating some kind of a conflict. Okay. We have a green light bulb. Let's see if it works now. There we go. As of yesterday's close. Okay, so this was SpaceX yesterday. This was the volume. We can see it traded almost 1 million calls, 773,000 puts. What was interesting to me were a couple of the big trades we saw. I'm going to highlight those now. So this was one of the big trades that we saw. Well, actually, there was... If you look right here, I don't know if you're going to be able to see this really well, and hopefully our crack production staff will be able to blow this up. So these first four lines here, September 220 puts, and the 220 calls, and the 205 puts, and the 225 calls. So if you put all of this activity together, these look like collars to me. This was one block. This was another. We're going to focus on this second one for now, because I rather like the math in this one. So almost 7,500 September 205, 225 collars. That's what I believe this is. What's a collar? That's when you sell an upside call, use the proceeds to help finance a downside put. And if you're doing it, and this, this is kind of an odd lot size, 74.66. Probably this is because the trader was actually initiating several of these, and the overall volume was probably higher and probably doing multiple of strikes. So that 200, 220, probably a similar market participant. I mean, a $20 collar going out to September in similar size, taking place around the same time, probably the same initiating trader. But what are they doing? For simplicity, if you got a 750,000 share IPO allocation, so you paid 135 for 750,000 shares, and you wake up and 2 days later the stock's trading $200, and then you realize, oh, wait a minute, I can sell the 225 calls, buy the 205 puts for round about even money. That means that you still have another 10% plus of potential upside that you can realize, and that's substantially more relative to the price you paid for the stock. It's almost 15%. So you paid $135 for the stock, and you have $20 worth of additional upside, and you can lock in your gains. This is an attractive trade for you. You might say, you know what? Bulls make money, bears make money, pigs get slaughtered. I'm not going to be a piggish, greedy guy, so I'm going to say I got $135 stock. It's trading $200 and change. I'm going to lock it in at 205. In this case, you're locking it in for almost 207 because if you can see this, you bought the puts in this case, paid 40.30 and sold the calls at $42. So you're actually collecting $1.70 in premium. So you actually are getting in an effective sale of the put strike that you own plus the premium you collected to put the collar on in the first place, which is going to be 206.70. So not bad for a couple days work, right? So worst case in that instance, you are selling 206.70 stock versus 135 IPO price. That's a 53% gain that you have now locked in 2 days after the stock started trading. Okay, good. Interesting, but if you were not participating in the IPO, this does very little good, right? You're just like, well, thanks for rubbing it in my face. I didn't get any. I didn't get any IPO stock, so I'm not this person. What were other people doing? Well, the very next trade down is this one here, which is kind of interesting. Somebody paid almost $7 a contract for 7,000 July 325 calls. That's an outlay of $490,000 worth of premium, plus commissions. We'll call it $500,000 just to keep the math easy. So you're risking $500,000 on a bet that SpaceX is going to exceed the 325 call strike by July expiration. Now, this is where we're going to kind of get back to this earlier concept I was just talking about. You are betting that it's going to be above 325 by the $7 you spent, or above 332 by July expiration. The stock closed around 200, so you're basically risking $500,000 on a bet that the stock's going to be up another 60+%. And that probably seems a little foolish as well. But the buyers of those calls might not have ever been planning on holding them all the way to July expiration. They might have just figured this is a way for me to get some long deltas to SpaceX and not planning to hold them all the way to expiration at all. Or they bought those calls and said, I'm going to buy these calls, sell some stock against it, delta neutral, and if the stock continues to rally, I can sell more stock against them. If it starts to fall, I can cover my short, and I can do this back and forth as SpaceX whips back and forth. So that person would be said to be trading their gamma. The gamma being the second derivative, the gamma being the convexity that the option offers. And then they're just trading volatility. So it is possible that you could have somebody who bought those call options just using them as something to lean against with the stock, just like the person who owned the stock bought that collar and used that to lock in their gains. Now, the buyer of those calls could be trading the stock back and forth. The seller of those calls, now, it happens to be market makers that sold it, and I know that because it's, if you look over here on the right, this is going to be a little bit hard to see, but you're going to see a little label over here that says ISO opening. What does ISO opening mean? Well, opening, all the trades were opening. We know there weren't any closing trades because it was the first trading day. There was no open interest coming in the day that could be closing, so this was very likely, and it was early in the day too, so it was within the first hour of trading. But an ISO, some people say ISO, it's an intermarket sweep order. What is that? The intermarket sweep order is when you have a big block institutional options trade that you need to effect, and you don't do it in a negotiated fashion. A negotiated trade is when one trader calls another and says, hey, SpaceX July 325 calls, how are you? And somebody says, well, I'm 6.5 at 7, 5,000 up. I'll pay 7 for 5,000. Done. Something like that. That would be a negotiated trade over the phones. Or you could use something called an RFQ, or request for quote, which is an electronic message or a text message of sorts that goes back and forth between traders, and you use that to get many dealers to compete. An intermarket sweep order is an algorithmic trade where you enter an interest into a system, much like you do into your own self-directed brokerage platform, and because the trade is so big, it tries to sweep all of the liquidity that is available. And the more intelligent sweep mechanisms will be refined enough to even know what the latency is on the respective exchanges so that they can fire the orders in such a way that they time it down to, in some cases, believe it or not, microseconds, so that you can basically lift as much liquidity as you possibly can in a very, instantaneously, effectively. And so that reflects a trade that took place on multiple exchanges, but it was a single order. And you can detect that because, of course, you can see the order just going off, and that's what Trade Alert is doing here. So now you have this situation that I was talking about where it may prove that buying volatility and hedging that gamma between now and July expiration is a good trade. And it might also be true that selling options of a given strike is a trade with a decent amount of edge, because the likelihood, frankly, that SpaceX is going to trade above 325 by July expiration is quite small when you consider how much the stock would have to appreciate. Let's take a look at where it is right now, just to get some sense of that. And I was looking at, as I have been lately, paying a little bit of attention to how semis and everything else are playing. This is just going to, so we can see it closed at 192, down about $10. So 325 versus the closing price, 70%. And that would mean that you would have to have an increase in the market capitalization of almost 1.8 trillion from here. That's a big number. However you happen to feel about this company, I think we can all agree that that's an ambitious increase in the valuation to take place over the course of the next 4 weeks or so. So I would actually suggest that selling options is a trade that typically yields very intriguing results on a risk-adjusted basis. Maybe not the compelling, you see an advertisement that says, oh, you could trade the stock or you could trade the options, and if you trade the options, you could have made 10 times as much. If you're selling the options, no, that's not going to be the case. But you can increase your probability of success quite materially. And that's what's going to get me to this ETF that's up on the screen behind me, run by my good friend Carter Worth. And one of the things that he is doing that's a little bit different is that he's selling both puts and calls, so-called strangles. Now, he's hedged on the upside. But what this means is that the underlying strategy isn't taking on a lot of delta instantaneously. So delta is the sensitivity that you have to the underlying asset. Now, he's doing it on a wide array of underlying stocks. So kind of like, our Alti fund at YieldMax, which has collared long equity positions, call it 30 securities in it. Biggie, which is, our large cap 50, has, as the name would imply, 50 stocks in it. Quad D, which is low volatility stocks paying dividends, has 100. This one has, I think, about 40 in it. Let's just take a look at what some of those stocks are right now. And this is less about these stocks, so I don't want you to focus too much about that. This is more about strategy, and it's a little bit about process, and it's about risk, reward, and return characteristics. So I'm just going to sort this by the ticker. This is as of last night's close, so this would not indicate trades that may have taken place today, but this is as of yesterday's close, so we can see Apple, Akamai, Albemarle, AutoZone, Best Buy, Caterpillar, Datadog, Dell, We got some gold in here. We got Goldman Sachs, IBM. We have the Jets ETF. We've got McDonald's. We've got oil, Roblox, Smuckers, Semis. Oh, we've got some SpaceX in there already, so traded it on its very first day. Nice. Tractor Supply, oil, Western Digital, Utilities, Zscaler. Names like this. So a well-diversified basket of underlying securities that are not necessarily going to track one another. In some cases, actually, we got a really good example of a couple things that would absolutely be not tracking together. USO, which is oil, that's the U.S. Oil Fund, and OIH, which I saw in here, over here, OIH. That is certainly not going to be correlated with jets. And he threw jets in here. This is interesting. We just talked about jets. I think we talked about jets on Monday. I think we did. I meant to. So obviously jets, which is the ETF that has a lot of the airlines in it, is going to move in the opposite direction of oil prices because oil is one of the big operating expenses for an airline along with labor, and depending on the price of oil, it may be higher or lower. Lulu, consumer discretionary, probably anti-correlated with oil. Starbucks, another sort of consumer discretionary type of name. If you're paying $6-7 a gallon for gasoline, which you can around here, maybe you don't also want to pay $6 or $7 for 16 ounces of coffee. So, I mean, consumers are gonna do what they're gonna do. But I'm gonna guess that if your checkbook is being pinched in one area, it might discourage you from using too much of it to spend in another. All right. Well, here's the thing that is rather interesting is that if you sell upside calls and you sell downside puts, instantaneously you are not making a directional bet on the underlying stock. In fact, the bet you're making is that the stock's really not going to do a whole bunch at all. But what is also interesting about that position is that even if the stock does move, as long as it between the strikes, your position's P&L day to day is not going to be that high. So you're going to see relatively low volatility. And that's the funny thing about selling volatility is that if you do something like a buy right, you own the stock and you sell an upside call, you are still going to have the volatility associated with the underlying asset for the most part. It will be muted slightly by the sale of the upside call. It will be muted slightly less if you sell upside call spreads the way we do it. But if you are just short an upside call and you are short a downside put, and they are about equidistant from the current stock price, instantaneously the movement of your position is going to be pretty small compared to the movement of the underlying stock. So this has only been around now for, it's June 16th, end of April, so we've had all of May plus almost 3 weeks, right? So it's not even 2 months. Total return north of 2%, 16% annualized. So far, so good. But this is the thing I want you to pay attention to, that short options premium, and the reason I thought this was really illustrative in a way that some other strategies that are long or short the underlying equity might not be, is that the volatility of this basket is really quite low, right? So this doesn't have options on it, so there's no implied volatility. I'm just going to get rid of that. Oh, actually, no, I'm going to put this back in. I'm going to put two other things in as well. So let's put a little HYG in there. And that does have options on it, but I just actually want this. So now I've got, what was the first day that we had that? I have to go back to mid-May, because in order to have 30 days of realized volatility data, you have to have 30 days. So I'm going to, it's a limited data set. I realize this, but I just want to sort of illustrate this. I think it's going to be helpful. And SPY, this is, we use this as our proxy for the S&P. And I'd just like you to take a look at something here. So, what do we notice? You will notice that if you pull the equity component out of a short out of a short options strategy. So you're just dealing, this is kind of options income pure play, right? So that you're not really having to contend with or focus on the underlying behavior. Notice what you have. HYG, high yield bond fund, right? Sometimes referred to as junk. That is the line in white. And an options income equity overlay, that's the line in orange. All right? So what you can see is that the volatility characteristics of the short options income strategy is a whole lot more like high yield than it is like equities up here in green. I mean, you can see that it moves up and down a little, but I mean, this is orders of magnitude lower, and it is a lot flatter than the equity premium is. And the reason for that is because if you invest in a bond fund, the value of the bond is really going to be driven by two things: credit and rates. And those things can move, but they don't move a lot. They don't move fast. And if you are short options on both the upside and the downside, and you're pretty much well away from the equity, you're collecting premium. Do you take some potential risk? Well, ultimately you do, if the underlying equity moves a violent amount. But in a diversified portfolio, everything's got to move by a wild amount. And when I talk about the yield max strategies, let me mute that. And actually, by the way, the reason I'm wearing the headset is because my normal earpieces, which I have right here, these things are battery operated, and of course I forgot to plug them in. So they probably still work, but I thought it would be bad if I was doing this and all of a sudden the whole thing crapped out. So hence I'm wearing these. Covers up my bald spot also. So what you can see is that you're getting more of a bond-like volatility characteristic. And I'm using high-yield bonds because high-yield bonds do have credit risk. And that's kind of arguably a fairer way to think about this. You shouldn't think about this as like a treasury security or anything. But maybe like a high-yield bond fund would be a good way to think about it. But where it gets interesting is that when you compare the results, you can end up with something that looks a little bit different. That number looks a little different here. It's actually slightly north of 2. And that is that the rate of returns for the equity options income piece can be considerably more compelling. So we'll do this. I'm going to do it just for the same period of time. So total rate of return from April 27th to present. In this case, this is net of fees, nearly 16% annualized, so that's quite attractive. And I'm going to just go here for the same period. 04 17, was that right? Did I get that date right? 27. 2026. So 4.2% annualized total rate of return now for the high yield bond ETF. A little bit more rate sensitivity, by the way, in the bonds, typically depending on how much duration they have, because an options income fund, while it can have some sensitivity to interest rates, most options income strategies are selling pretty short dated options. So for us, we have 60 plus funds. We're dealing with options that expire a month out or less, generally, right? So something like a quad D, that's a monthly. Target 12's biggie, that's a monthly. But most of our other things, if they have weeklies and they distribute weekly, it's going to be trading weekly options. So very short dated. And the shorter dated the options that you sell, the less rate sensitivity they're going to have. So when we think about what the sensitivity of an options price is to changes in things like interest rates and other elements of the cost of carry, like dividends, that's in Greek terms, we call that sensitivity rho. Again, I'm not trying to make things complicated. I'll throw it out there. Don't worry about it if it doesn't interest you. But when you look at bonds, the longer dated a bond is, the greater its sensitivity is to changes in interest rates. We call that sensitivity duration in the bond world. So long duration, high sensitivity to interest rates, low duration is going to be lower. TLT, long dated U.S. Treasuries, is like basically as long duration as you can get. And something like HYG is going to be much less. I don't remember offhand what the duration average for the high yield bond fund is, but I'm going to guess it's in the mid single digits. And for LQD, which is the corporate investment grade bond ETF, it's probably mid high single digits, like 6-7 would probably be the duration. For most options income strategies that you would employ or that you would buy through an investment product, the way we talk about the sensitivity to interest rates, in this case, it's not duration, it's row, but the row is going to be very low because you're dealing with short-dated options. So if you can imagine that a 20-year Treasury bond has a high sensitivity to interest rates, an option that expires in 20 days is going to have a very low sensitivity to interest rates. And so it is here. Now, what the net effect of this is, though, is let's just take a look at what this works out to. So let's go back to, just remember this number for just a second. So this is high yield bonds right now. High yield bonds annualized rate of return is 4.2. That's only based on this limited period of time, right? So we're dealing with less than 2 months. The high yield bonds, our expected return over the course of the year should be higher than what the risk-free rate would be. The risk-free rate's around it's in the mid-high 3s. So you're going to expect to do better than that. You might actually take a look at 10 years and say, okay, well, what's the 10-year? And say that my expectation for I'm taking additional credit risk, right, relative to 10-year treasuries. Duration of the 10-year treasuries a little bit longer, I think, than HYG, but we'll just take a look at that. So let's see what the 10-year closed today. So the 10-year closed at, 4.48. So let's just say that you think for the credit risk, and I'm doing this to keep the math easy, I should earn another 150 basis points. We'll call it 151 and change so that I can, again, keep the math nice and easy. So that means 6%, right? So let's say that I'm expecting to get 6% annualized at the prevailing rate of interest and state of the economic world to get 6% out of a high yield portfolio, or maybe a little bit better. So 6-7%. 6-7% with what we saw here, very low volatility, not bad, right? So if I said I can give you an investment that's going to give you 6 to 7% annualized, and the volatility of that underlying portfolio of securities is going to be, 4.5, that's a reasonably attractive risk-adjusted rate of return. Now, if I said you can do that, or you can do an options income overlay strategy, which will have, as you can see, and this is, again, a very limited data set, but is going to have a comparable level of volatility. That's a good picture of me, by the way. I think that was taken like a week ago. So comparable levels of volatility, but now we're looking at an annualized rate of return that's, in this neighborhood, like 1% a month, let's say. This is ambitious. Is off to a terrific start, I think it would be fair to say. 1% a month. What do we think about that? Well, let's just say, what are you getting? If you can get 12% a year off of 4% vol, how is the Sharpe ratio calculated? That's a common metric of investment performance in alpha. It's it's your returns relative to your volatility. So you're getting a very high Sharpe ratio. So the question you probably are asking yourself now is like, well, why the heck doesn't everybody do this then? What's going on here? And has any work been done that suggests that there is edge to be had by being an option seller? And the answer is that there has been a lot of work done. We refer to this as the volatility risk premium, and it has often been suggested that the volatility risk premium is persistently higher than you might expect it would be. And there's a couple of reasons why this is true. One of the reasons this is true is because people will take a look and say, well, short volatility, that means I'm getting short this thing. I'm getting short the VIX, for example. And people say, well, if I look at this over a long period of time, to my eye, this looks like a mean reverting process. And that mean is probably somewhere around here. But the problem is that when I lose, I can lose huge, right? So if I'm short at an average of 18, like whatever the mean is, then when it goes and does one of these things, I'm going to be punished brutally. And the issue I have with this is that being short volatility and being short options are not exactly the same for the reasons I previously described. Because if you are hedging your gamma continuously, you might indeed experience a P&L that looks more like this. That's not to say that there aren't adverse things that can happen. If the market falls by 20% and you're short a lot of puts, or if the market rockets by 20% over the course of a very short period of time and you're short a lot of calls, you are going to face some pain. But it probably isn't going to look exactly like this does. So this is probably exaggerating to a degree the pain that an unlevered short options income strategy would experience. And here's the reason why this would be true. If I sell 10% out of the money puts on stocks and the market, plummets, no matter what happens, I cannot lose as much as the equity did, because the risk I'm getting paid to take is that I will buy those stocks at a 10% discount to the prevailing market price. So if they fall by 15%, the most I can lose is 5. I sold at 10% on the money put. They fall by 15, the most I can lose is 5. So my downside volatility must be less than owning the stocks. And similarly, if I sell 10% out of the money calls, I'm not saying that's how far out of the money they are, but it's, again, as you guys know, I like to keep the math easy. 10% out of the money calls, and I'm short stocks. Well, if they rise by 20%, at most I can lose 10%, whereas if I was short the stocks, I could lose 20. So the volatility of this portfolio, it's the extreme case loss, assuming that you cap the losses to the upside in particular, must, on an unlevered basis, always be lower than simply purchasing or shorting the underlying stocks at the levels when the trades were initiated would be. And that's the reason why you exhibit this kind of behavior. So let's talk about some other reasons why these things might be unattractive to institutional investors in particular. One of the problems for institutional investors is that they are short convexity by their very nature. And what do I mean by that? If I run a university endowment, contributions to my endowment are probably going to go down when the market goes down. People contribute when they feel rich. Demands for aid for students' tuitions, if that's paid out of there, those demands might go up. There would be a whole host of reasons why the demands on the endowment might increase as securities prices fell. So you have this really unhappy confluence of events in that circumstance. Your portfolio is dropping, the contributions to that portfolio are dropping, and the demands on that portfolio are rising. And in that case, you might not want to own funds that are short convexity, because you are by your very nature short convexity. This is going to be true for most pensions and endowments. You have an economic drawdown and you encourage more people to take early retirement. You have fewer people contributing to the pension, you got more people drawing on it at the exact same moment that all the value of the securities inside of it have declined. And this is the reason why tail risk funds are so appealing. But as an investor, the question you might want to ask yourself instead is, how do I get myself to a point where I'm just delivering more alpha in general? And so selling options, I think, is really important. And I really liked using the example for worth. So let's just look right before I get your questions. I'm going to do that now. SpaceX. Didn't get in on the IPO? No problem. I got a solution for you. It involves selling some options. So look at August. I was looking at these yesterday. The IPO price was 135. Okay? If you're watching this and you didn't get in on the IPO, well, these puts have already come in quite a lot. Still not bad though. When I wrote about this yesterday, these things were 8 by 830, and the stock was higher, by the way. So this is illustrating something that I also think is really important, is that volatility for IPOs comes in, and it tends to come in pretty hard and pretty consistently. So if you're going to sell options premium on SpaceX, you want to do it sooner rather than later. We'll start with that. But if you sold the 135 puts, which you could easily get 6.25 for, it looks to me, as of today's closing price, what's the risk you're taking? The risk you're taking is that you will be able to buy SpaceX possibly, or someone could put SpaceX to you at $135. So the risk you're taking is that you buy SpaceX at the IPO price. 135 versus today's 192-ish closing price. That's a discount of 30%. Okay, so that's the risk you take. How much are you being paid for the risk? Well, like I said, I think you can sell those for 6.25. The 6.25 over 135 is 4.63%. This is 2 months away. So you multiply that by 6, because that's basically annualizing it. That's 28% annualized. So you're selling the 135 put. So essentially, you're getting a 28% annualized rate of return for taking the risk that you might buy SpaceX at its IPO price, a 30% discount to where it is right now. And by the way, your effective purchase price would be lower because you have to factor in the fact that you got the 6.25, so you're actually going to end up owning it below 129. All right, let's take some questions. All right. Dennis Yavi, hello everyone. Is the teacher attending any FIFA game? Feedback on new Fed leadership. I am not going to any of the games. Well, it's a little hard for me to get away from the screens in the middle of the trading day, admittedly. So I'm not doing anything while the market's open. I'll tell you that much. So I'm probably not. I have already watched a little, though. I was watching some of Qatar versus Switzerland. I don't know if any of you guys happen to catch that. That was interesting. Switzerland was leading the entire game, or I think from the 17th minute on. And then it felt like 2 minutes to go. It had to have been in that neighborhood. Qatar scored and tied. So that was a pretty. I was watching the Swiss goal, oh my God, that's a tough one. Jim Forbin, today markets were taken out in the wash. I'm like, can we expect more downside prices in the Qs and the SPY in the next 2 weeks? All right. I got to tell you, if you guys haven't picked this up from me already, this feels vaguely familiar to me, what we're going through. I have said many times that when the market's at all-time highs and volatility starts going up, particularly in the things that led you there, that does get me a little anxious. And a 12+% drawdown in 2 days is a big move for a basket of stocks. That's the kind of thing that started to happen. And look, just because things look the same doesn't necessarily mean that they are the same ultimately. But I will tell you that, and I've shown this chart, and I'm going to do it again, because I want you to pay attention to this bit right over here. So this was the semiconductor index at the end of what's now commonly referred to as the tech bubble of the late 90s and into 2000. And one of the things you're going to observe is that the stock price movements, things went higher and they started to go higher faster. But one of the things you'll also notice is that when we started to see some moves lower, they were pretty breathtaking. So here's a 2-day move off that. Okay? So that's 9.66% between, actually that's 5 days, between the 10th and the 15th. Pretty sharp. And this was an 18% move, and that was over 6 sessions. 6 sessions or 6 calendar days? That was from the 4th to the first of 4 days, and 31. So that's basically a week, okay? A little bit more. Calendar week. And now let's just fast forward to the present. And take a look at what we got. So we have a very similar price action. And then all of a sudden we started to get some rather breathtaking drops. And this one in particular I thought was extraordinary. So we had a 2-day drop between June 3rd and 5th of 12.2% for the semis. That is a really violent move. Now, we did make a new all-time high. That didn't happen oops, I went in the same chart. I shouldn't have done that. I should have kept them separate. We did make a new all-time high since then. So this is not, this period from here to here, this is not March 10th of 2000 definitionally, because we actually have hit a new all-time high since. But what I don't like is I don't like to see, price appreciation accelerate as it has done here, and for volatility to similarly increase as it has done here, because it just gives you a little bit of sense that people are really worried about when they're going to hit the, this is very much shoot first, ask questions later kind of price action, right? Everybody knows it's been good. Everybody, if you've ever ridden a motorcycle or you drive a car at speed, it's called covering the brake, right? You understand that there's a potential risk. You cover the brakes. Or you cover your trade. You cover your ass. I don't care what you say. But if you know that things have been good and you know that maybe they've been a little too good for just a little too long, you think, at some point the music stops and I am going to be ready to grab a chair. And even if I only get half a butt cheek on it, and, for those people that sold it down 12%, that's what happened to them. But their attitude was, listen, I bought it over here, okay? So I don't care. If I'm selling it here, I just don't want to sell it down here. And that's what that price action says to me. That's the psychological feeling that's being telegraphed to me when I look at a chart like that. I don't know. So I think that's a little bit, it's just something I'm keeping my eye on. So I would look to the market leadership and look for that kind of breathtaking gap, stuff like that. So, yeah. FinWest, excited SPCX SpaceX options are available so quickly, even if just monthly. I didn't get any IPO shares since I missed the confirmation window. Can I just sell a 135 strike puts and get paid to wait? So I guess I should have read your question first, because obviously I'm not joking at all. I think that's a great idea, and I wrote about it and I just spoke about it. So I think that's a good plan. And like I said, the volatility trend, I looked at, and hopefully I can find this study. I kind of remember it was 11 years. I mentioned this before, but right before the Facebook IPO, I went back about a decade plus and looked at every single IPO that had listed in the prior decade and looked at the volatility behavior of that stock and its options in the year since. And I did that so that I could forecast, using that as a composite, what one might expect to happen with Facebook options when they listed. And actually, now that I think about it, it was almost certainly more than a decade, because they listed in 2012 and I would absolutely have caught a lot of the IPOs that were in the late 90s and early aughts. So, but the trend is that volatility starts here. So for as you go out in time, so this is T1. That's the minute that the IPO takes place, and the options list shortly thereafter, and the pattern is something like that. And the reason is because there's a lot of uncertainty in these early days. Everybody's trying to figure out, was it priced correctly, and then maybe it gaps higher and gives a little bit back. So there's a lot of volatility, but the volatility tends to get sucked out pretty early. And this thing is not, SpaceX is not going to become like Procter & Gamble anytime soon, so don't worry about that. But it will be lower vol. You're not going to have a 1 month straddle priced at 30% of the stock price. That's where it was when it opened on the first day. So when SpaceX options opened immediately, the July straddle was 30% of the stock price, over $60. That's not going to last. So get it while it's hot, or sell it while it's hot. How about that? Okay. Sold SpaceX July 31st, 200 puts at 22.47, break even 177.53. If it's on, I'm okay either way. Yeah, that's fine. I like that. I will tell you that I probably would be more inclined to sell a lower strike put, give myself a little bit more dry powder, and even sell an upside call, like sell it, or call spread at least. In other words, the thing is, one of the nice things about selling straddles, selling upside and downside, is that the stock can be right where it is right now. It can be higher or lower. It can't be both higher and lower. Right? So if half of the risk I'm taking is that it goes through some strike that I've chosen to the upside, and half of the risk I'm taking is that it goes through below some put strike that I've also sold, then no matter what happens, I'm not going to be taking as much risk as if I take it all directionally one way. Right? So something to think about. I think that the trade is probably fine, and you're going to actually, here's the thing, you're getting an opportunity to close that thing at a profit probably beforehand because of that other dynamic I was talking about, which is that the implied volatility is going to drop, and it has already been dropping, and dropping really fast. Actually, let's take a look at that. I mean, what did I just say? I just mentioned that the July straddle was $60 on the open yesterday. $60. It was actually more, just over. It's like $62 and change. And I bet you it's nowhere close to that now. 190. So we're at 191. We'll choose a 195s. What the hell? So 19.5, 21, 40. It's lost 30% of its value in a day. So the ball's coming in. Amazon, August 21st, 250 out of the money long calls. Will Amazon break its all-time high of 278 sometime this year? And do you see it crossing above the 3 handle, as Carter would say? Let's take a look at Amazon. That looks tough. I'm going to get rid of this annotation. Let's do this. I like Amazon, by the way. I just want to make that point. Well, you were looking at the August 21st 250s. Right there. I was on 250, but that's fine. So you're basically... Did you mention what you paid? So do I think that it is going to get from here to there by... Oh, no, you wanted to know by the end of the year. Well, that, I think, is achievable, assuming that the rally continues. Right? Right now, this feels like we're going to... I feel like we're going to hit the 150, and I'll just put that in. But I think we're going to hit this level before we hit this one. That is my suspicion. And like I said, I mean, I am a little anxious about what's going on with the leadership right now. The fact that when it does get chopped up, it's getting hit as hard as it has been. Okay. Joe came and took your advice and put on a bearish triple Q. Bought the August 745, 760. I usually say the higher strike first, so I'd say the 760, 745 put spread. I am not reading this right. There's no way. Because you would never pay $20 for a $15 put spread. So there is a typo in there. Oh, you did say the higher strike first. I see what's going on here. You inverted the 6 and the 7. Okay. All right. That makes more sense. Sorry, I didn't see your subsequent message. Okay, so if anybody's paying attention, this is it. So the 745 670 put spread. So that is obviously a much wider $75 put spread, 2077. Yeah, I mean, here's the thing, right? So here's the trade-off that one ought to consider. The bang for this, an advantage to going further out in time, like to August, 2 months. I think when I was talking about this, I was saying just in terms of bang for your buck, if it's a tactical bearish trade, I will typically like the idea of going in that sort of 30-day range, 30-day, 30 delta put on the long side, and then sell another put against it. Try to get about 30% of whatever you paid for the higher strike. Why is that? Two reasons. One is that the risk-reward relationship, the payoff, will typically be higher, which it should be, because the chances that something goes down to or through one or both of your strikes is greater the longer time you have. So you would expect the reward to be greater if you don't give yourself as much time for that to pay off. So a shorter dated one. But the issue that I have is that sometimes, and certainly we've seen this recently, if you have a really sharp sell-off, you can have a very sharp V bottom. This, I don't need to switch. I mean, we're just looking at Amazon, but all we'll know, this was, that we had the Liberation Day tariff sell-off, killed stocks. Then, the reprieve was granted and they V-bottomed. If you have a longer dated vertical, it will not go to the full value of the distance between the strikes. So you're going to have less decay. That's a plus. You're going to have more time for it to pay off. That's a plus. But the payoff, if you get a sharp pullback, is not going to be quite as good. So just a couple things to think about. If you buy a longer dated option, its decay as a percentage of its own value instantaneously is going to be slightly less anyway. Consider buying that put, and then if it starts to work your way, then selling some downside premium, legging your way into the spread rather than putting the whole thing on at once. That's one way I would consider it if I was going to use a longer dated option. Personally, I'm probably more in the camp of slightly shorter, just because you get a little bit more convexity. If you're just trading a single leg, then give yourself a little bit of time. But there's nothing wrong with that trade. I mean, you're paying, if you pay a quarter of the distance between the strikes, you've gotten a good deal. That's a 3-to-1 payoff, so not bad. In this case, we'll just call it $21 over 75. So that's paying 28%. That's very close to the 25 I was talking about. Not quite 3-to-1, but close enough. Close enough. So I think that's a fine trade, Joe. Okay. As you listed the worth holdings, I see most of the strangle positions expire tomorrow, really short dated. Yeah, so he's not trading daily options, but tomorrow happens to be this week's expiration day because we have one of those strange circumstances, unusual national holiday. Markets are closed on Friday for Juneteenth in this case. And so, we don't get a whole lot of those Friday holidays. Good Friday was another one. Those of you who watch the channel know that that actually created an interesting setup in Netflix because Netflix still held their earnings call on a Thursday post-close. And if you were paying attention, you actually had an opportunity to trade some option spreads where there was probably a good chance that you wouldn't get assigned on everything on the short side of the stock move shortly thereafter because not everybody knows what they're supposed to be doing. And they don't even know how, even if they know they should, right? So some people didn't know the next day was a holiday and that therefore their options were expiring. Other people don't know how to contact their broker and effect a contrary exercise notice. So things like that. All of those positions are going to change, and they'll all get rolled further out. So FinWest. Yeah, that's right. Good point. Producer just correctly pointed out, hey, that's yesterday's position, so many positions may have been rolled already. Excellent point. So those might not be completely current in any case, but you can expect those positions to be adjusted pretty aggressively on the expiration day. FinWest points out that Carter chose the 160 strike for SpaceX. Let's take a look at what that one looks like. And I don't know if probably the ones that expire, as you pointed out, maybe those are the ones that expire tomorrow. Those are already worthless probably, or close to it. Yeah, 15-cent option. But even if he goes further out to, say, July, if you sold the July 160s, you're going to sell those for $6.50. Maybe a little better. Downside is you put the stock below 155. Not terrible. I still like the 135s. It's a nice round number. The risk you're taking is that you buy the stock at the IPO price. 30% discount. That seems like an okay bet. With the benefit, are there people who wish they'd gotten it at the IPO price who will happily begin to buy it if it gets back to that level? My guess is probably yes. So, things to think about, because I'm going to wrap it up here, but here's what I want to leave you with is this. Selling options does deliver over the entire business cycle, over the full course of time, and I'm talking about on an unlevered basis, does deliver good risk-adjusted rates of return. There is a little bit of what we call kurtosis, so you're going to have a little bit of this situation where it's going to be very steady, and then periodically you're going to probably get some pretty big spikes in. But in general, it's very attractive, and I liked talking about this one because since most of our funds were taking directional bets, Misty takes directional bets to the long side, Winter takes directional bets to the short side, Tesla is to the upside, Crash is to the downside. So, but in each case, we're going to exhibit a considerable, call it 70, 80% of the volatility of the underlying stock. But what selling calls and puts without having a position in the underlying stock does is it just shows the volatility of short premium without having the underlying in it. And I think that is important for people to understand. And you can see that if you buy bonds, you are selling puts also, by the way. Because the most you can hope to get back is the money you put in plus the interest. So you don't get a call option on the equity. But if the company goes bankrupt and they don't repay their debts, you could lose, arguably you could lose everything. I guess in high yield, most people use 40% recovery rate in a bankruptcy as their sort of benchmark. I don't know whether that's really the current thinking on it, but it's a way to think about it. I still maintain that in an environment where, because we're talking about Warsh, if we have less excessively easy monetary policy, money printing, driving rates to zero, yield chasing, all that kind of nonsense. If we get less of that, I believe that it becomes a better environment for option selling. Because you're not going to get as much of this valuation expansion, multiple expansion, and I think you're going to go back to a more even-keeled sort of risk environment. And I think you distort things very violently, and that hasn't been great for short option strategies because we can see that stocks just go parabolic. Much easier just to buy risk assets. But I think we're going into a period of time when people are going to want to consider these things much more carefully. So I hope you do that. And I also hope that you guys enjoy your 3-day weekend. And we look forward to seeing you here next week. So thank you all very much for watching.